All right, welcome everyone. We are here with another weekly wrap. I have with me Pankaj Pandey sir, and this has been an interesting week, sir. I think in the second half of this week, all our portfolios have bled. Nifty has given up quite a few points. What is happening, sir, and what's the outlook from here on?
So, hi, good evening, Vishu. Yes, see, after 3 weeks of winning streak, we've seen markets correcting this week. Lastly, you had geopolitical worries which impacted the markets, and on top of it, you had SEBI's new guidelines on the FNO, which impacted the markets, which we'll sort of discuss. But what has happened is that because of these, we have seen sharp sell-off of nearly 4% or slightly more than that during this week. One space which did very well was metal, largely because the China came up with the stimulus, and on top of it, the government was talking of putting some anti-dumping duties. So that sort of helped. And I think while this week we have seen a lot of volatility, next week is also going to be equally more sort of volatile. Because see, you have RBI policy, and then you have the earning season will sort of start. Geopolitical tensions are still persisting. We still don't know what kind of action Israel is going to take against Iran. So that is always a worry. But having said that, if you look at this year, we have seen markets correcting 5 to 6 odd percent. You have already corrected shade over 4%. And typically, market once it corrects 5 6%, typically overall the market tends to sort of bounce back. So from overbought kind of a situation last week, we've gone into a oversold kind of a situation. So our sense is that supports are somewhere about 24,800 kind of a levels, and market should stage the bounce from those levels. And I think as a casualty of all this geopolitical tension is that we've seen crude sort of going up to $78 even more, and there's a possibility of further inch up there. And crude related beneficiaries also have seen a sort of a liquidation. So from that perspective, it's been a very volatile and not so pleasant week, I would say. And but there are some pockets like, say, for example, IT, metals, pharma, which are relatively looking good. Otherwise, I think next week volatility is here to stay even for next week. We don't think it is going to subside early.
Right, absolutely, sir. Sir, you mentioned SEBI guidelines have changed regarding FNO. So, what are the key takeaways, and how do we understand them better?
Yes, so SEBI had come up with a consultation paper sometime back, and they've adopted the entire gist of it, everything, almost all the points they've incorporated in their recent regulation. Now, if you look at India's derivative market, 98% of the volume happens in the index options. And I think with this recent step, typically our sense is that we should see more than 30% kind of a drop in the overall index volumes. Now, there are a number of measures which they have taken. Primary among them is that what SEBI has clearly come up with is that they are restricting only one expiry per exchange. Now, currently, if you look at NSE has got 4 weekly expiries, and BSE had 2 weekly expiries. And our sense is that if you look at Sensex has already said that, or BSE has already said that they are keeping Sensex as their weekly contracts. NSE is yet to come out with the details, but NSE besides Nifty was having weekly expiries in Midcap Select, Financial Nifty, Bank Nifty. And so, to give you a color, if you are sort of removing Bank Nifty expiries itself, that should lead to option volumes dropping more than 20%. So that is one of the measures what they have taken. The other is that they have increased the contract values to 15 lakhs. So if you look at currently the contract values are about 6.5 lakh because the lot size is 25 and your market is trading at somewhere about 25,000 kind of levels. Now, to comply with the regulation, the lot sizes will increase from say 25 to 75. And this would mean that a lot of small retail participants will find it challenging to participate because your premiums will also sort of go up. Then what they've also done is that they have increased the or put 2% additional extreme loss margins on short positions on expiry days. Now we all know that most of the volumes happens on the expiry days, especially in the last hour of trade. This margin of 2% is going to definitely impact. Our sense is that the overall volume impact could be 6 to 8 odd percent, because your margin requirement is going from 12 to 14 odd percent. And then I think exchange or the SEBI has come out or has eliminated calendar spread benefit for contract expiring on the same day. And obviously, this is going to hamper the option writers' ability to sort of write large volumes. Now, when you look at the overall implications of this, is that yes, while global factors have been played, but our sense is that the kind of declines what we see in our markets on the Thursday and Friday is largely more to do with the new derivatives rule by SEBI. So, for example, if you look at the beginning of this month, FI longs were quite high. So they were having about 3.6 lakh crore, six contracts, 3.6 lakh contracts at the beginning of this month. So they were quite bullish. They have sort of cut it down to about 1.6 lakh contracts. And that resulted to a sort of a good amount of decline. We've seen FI flows of outflows of about 15,000 odd crores. And when you are sort of limiting the expiries per exchange to only one, so many indices like Bank Nifty, Financial Nifty, Mid Cap Nifty, or Mid Cap Select will not be available for derivative trading post November. If you look at in some of these indices, say for example, Bank Nifty, you had two private banks were constituting 50% of the index. Similarly, in your Mid Cap Select index, you had stocks like Indian Hotels, Persistent, and Lupin. Now, these stocks have done very well because the hedge funds used to buy these stocks in cash and write positions in the FNO. Now, with expiries not having for these or will not no longer be having expiries for some of these, which means that the hedge funds have to sort of liquidate their positions. And which is why if you look at some of these stocks have been seen a good amount of cuts in the last 1 or 2 days. So our sense is that overall, you are going to see some pressure till the time a lot of these hedge funds sort of move out, and which is what is clearly getting reflected in the last, say, Thursday and Friday, and possibly some more days. But yes, so while this pain is definitely looking like a sharp cut, but I think this is eventually going to make markets more healthier, because I think the FNO volumes had gone to a proportion where some curbing of through regulation was expected. So a step in the right direction, but yes, at this point in time, it's hurting a lot of people.
Right, right, sir. So let's talk about monsoons. The monsoon season is officially over in India, and so what are the key takeaways, and what can we expect in the market due to monsoons?
So yes, if you look at IMD had come up with a forecast of 106% of the long period average, and the monsoons have actually come out better than that at about 108%. Now, if you look at, if you sort of exclude, say, some of these states like J&K, which does not have a very significant agri production, Arunachal Pradesh, again, while it takes about 18% of the overall area, but no major significant production. And besides that, Punjab is another where there has been a shortfall in the rains. Now, Punjab is again a well-fed region from a canal perspective, so, so that should not have much of an impact. And overall, if you look at monsoon core zone areas, the overall rainfall has been pretty good at 122% of the long period average. And I think what is good is that it started slow, but in the month of August and September, the rains have been pretty good. And good part also is that your reservoir levels are also quite healthy at about 118% of the last year, or 114% of the last 10-year average. So reservoir levels are also good. Your winter crops are expected to be fine. Now, there are two, three key takeaways. One, your agri production is expected to be higher at about 340 million tons, up about 3%. So food inflation should not be a worry. And since your overall monsoon has been good, agri incomes are expected to be good, two-wheeler as a space should do well. And along with that, some of the select consumer good companies ideally should do well. So from that perspective, no major challenge is there. I think the rural upturn is expected to be sustained.
Right, sir. So talking about auto sector, I think the September volumes are out. What are the key takeaways there?
So one is if you look at so this data ideally should not be compared to last year because of the Shraddh period. So this time the Shraddh period was between say 17 September till 2 October, whereas last time it was towards the month end. So obviously the base was higher. But having said that, I think a two-wheeler as a pack is sort of outshining the rest of the segments. I mean, player after player have done very well. Bajaj Auto about 28% YY growth, TVS Motor 22% growth, Royal Enfield after a long period of time witnessed a good growth of 11 odd percent. So entire two-wheeler space is doing well, and we just spoke about monsoon being good, so that is definitely going to be supportive of the overall two-wheeler as a pack. On the PV side, I think M&M continues to sort of do very well. So they've seen volume growth of 25%. And I think this is the only company which is doing very well. If you look at, they've recently launched Thar Rocks, which again has got enormous amount of booking of 1.76 lakhs. That's massive. Otherwise, other players have seen muted set of numbers. And CV also, again, muted set of numbers. Tata Motors, the volumes are down 23%. For Ashok Leyland, it is down about 10 odd percent. A tractor is largely flattish and should benefit from good monsoon. And overall, if you look at this year is going to be year of two-wheelers. So two-wheelers are clearly sort of doing very well. Whereas PV and CV and tractor to a good extent are facing challenges because of the higher base.
Right. Right, sir. Sir, RBI also came up with a circular around gold loan business. How do we look at this sector in general, and how much of an impact will this circular have on the sector?
So I think, Vishu, if you look at RBI has been sort of targeting one segment after the another segment, and gold loan is another segment which they are sort of targeting now. Now, so they have asked the lenders to sort of adhere to the prescribed norms. So what they found out is that there are shortcomings in terms of using of third parties for sourcing and appraisal of loans. Then you're valuing the gold without the presence of the customer. Then there is a lack of end usage monitoring of gold loans where it is sort of going. And then there is a lack of transparency when you're sort of auctioning that gold or the jewelry. And LTV again has got its own set of weakness. And then your incorrect application of risk weights. Now, while it is good that the regulations are getting tighter so that you really do not create a bigger stress in the system, but it does impact because most of your gold loan companies have been doing very well in the past quarter, are expected to do well because we all know that US has just begun the rate cut cycle, and that should be beneficial for gold. And with gold on a higher side, it creates a good amount of tailwind for most of these gold loan companies. But with these kind of restrictions, overall, I think one, there could be some impact on the growth and probably some kind of extra provisioning might be required. So that might sort of lower some of the margins. But having said that, overall, the trajectory for most of the gold loan companies is expected to sort of continue, except in cases where the RBI sort of comes up with a specific guideline in terms of banning a particular entity, which we have already seen. Otherwise, our sense is that most of your gold finances like Muthoot Finance, Manappuram, or CSP, I think they are offering a fairly or a good risk reward at current levels.
Right, right, sir. So talking about upcoming Q2 FY25 results, what do you see happening in the banks?
So yes, banks have been are a big component of the overall market, and we have started getting business updates for some of these banks. Now, the biggest bank of lot is SEBI Bank. So there, clearly it is getting reflected in terms of the kind of growth. What you see is 7% in terms of advances. And deposit growth also has been sort of weakish. So from that, and largely, if you look at deposit growth, though has been sort of healthy, but this is more to do more to sort of correct the CD ratio, which is still above 100%. Otherwise, if you look at some of the banks like say Bank of Baroda, I think the overall growth rate has been pretty good at 12, 13 odd percent. And I think one thing is very clear that the deposit growth is still lagging the advances growth, which means that there'll be pressure on margins for some of these banks. So one way to sort of mitigate is grow their book into areas where you get better spreads. But off late, if you look at, there has been some or acceleration in terms of unsecured segments or NBFCs. So from that perspective, overall sense is that we are going to see pressure on the margins. Now, overall, our sense is that in this entire gamut of things, PSU banks are relatively sort of better placed because their CD ratios are comfortable. They don't need to chase so much of a term deposit, unlike private sector counterparts. So from that perspective, they are okay. Otherwise, I think we are because of this challenges on the deposit front. Our sense is that we are going to see margin pressure to the tune of 5 to 15 bips in the second quarter.
Right, right, sir. So last week we were discussing you saw some upside in the metal sector because of the China news, I think, and this week we saw that I think metals was probably the only sector that survived this bloodbath that happened. I think there is also a new regulation around the customs duty that is about to come up. How do we read that?
So I think a good part is that the government is also recognizing this challenge, and now they are in favor of increasing the basic custom duty. So what the government is saying that from 7.5%, let's raise the basic custom duty to 15 odd percent. And rightly so, because if you look at April to August, we've seen about 35% growth in steel imports at 3.5 million tons. And obviously, that is having impact on our domestic steel prices because steel prices have gone down even below 50,000 rupees per ton. I mean, it used to be about 74, 75,000 some time back. So that is the kind of extent of decline in the steel prices what we have seen. Obviously, it bodes well for some of the sectors like auto, but it does not really bode well for a core sector like steel because this is one sector which is doing one of the maximum capex. So I think with government siding with the industry, our sense is that you are going to see some measures, and definitely it is a positive news for the entire metal as a pack because this is one sector which hasn't done much in the last 2 years. And if China stimulus works and if the government sort of levies this or increases this duty, I think the worst is behind in terms of for the sector. What we are liking is again big players like say JSW Steel. I think the company is clearly ambitious in terms of putting up a capacity of 50 million tons and as one of the most efficient players.
Absolutely, sir. And sir, finally, hidden gem of the week, what will it be this time?
So what I'm recommending is Aeroflex Industries. So with a target price of 230, we had come up with a conviction idea on this company. Now, this company is engaged in the manufacturing of stainless steel flexible flow solutions or hoses, what we call. And these are typically used in oil and gas sector, chemicals, steel, port, buildings. Company derives 80% of the revenues from export and 16% from the domestic market. And globally, this market is growing at 8 odd percent. And we are seeing a shift from the unorganized to the organized segment. Now, this company has been expanding capacities to sort of tap this opportunity. So they expanded their capacity by 36% to about 15 million meters. And they're further expanding it to about 16.5 million meters. And I think they are also sort of looking to venture into high margin businesses like metal billows, where the margin profile is 25% plus. Now, our sense is that with this kind of overall capacity expansion and the shift what we are seeing, this company should deliver 25% CAGR in terms of overall revenues. A margin profile ideally should improve from 19.5% to about 22%. And that should lead to a pretty good profit growth of 37% CAGR. And which is why I feel that with this such a high growth, this stock should do well with a target price of 230.
Fantastic. Thank you so much, sir, for this enlightening weekly wrap. We'll be back next week. If you have any questions for Pankaj, sir, please do comment them down. Thank you so much again for your time.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.